Welcome to the Alchemy of Achievement. My name is Eric Brown. I'm with CG Wealth and a portfolio manager at Graham Wealth Partners. Today, we're going to be talking more about tax. It seems to be my favorite topic these days. And one of the things that is often overlooked is the taxation of your investment portfolio. And I know everyone gets their tax receipts, and if you look at one of my other videos, you can get an explanation on mutual fund taxes and the tax receipts there. But sometimes we just get it and file our taxes, give it to our accountants, or do it ourselves and pay our bill or get a refund and don't think about it again. But what if there is a way to significantly reduce the amount of taxes that you're paying on your investments? And I think it bears to be repeated that the after-tax return is really what you're looking for. So I know lots of people talk about after-fee return. Okay, that's important. But the after-tax return is less talked about just because it's a little harder to figure out. But one thing that we'll look at here today is a solution for that problem. If you want to understand what your taxes look like, you can talk to your accountants, or again, I'm happy to have that type of discussion too, but I'm looking at a way that you can reduce the taxes on your investments, primarily in either a business account or in a taxable non-registered personal account. So one of the things that you can use are something called corporate class mutual funds, or they're also tax efficient ETFs. So most mutual funds are in a trust structure. And essentially what they do is pass the taxes on to the unit holders, which is you, the investor. The other option within a mutual fund is the corporate class mutual fund. And a corporate class mutual fund is essentially just a corporation, a mutual fund corporation, and they have different things that they can do on the taxes. And if you can remember 5 or 6 years ago, maybe even longer, they changed the rules there that made corporate class mutual funds significantly less beneficial, but that doesn't mean that you can't get a benefit from them. And there are also new options that came up recently on the ETF side of things that allow you to get tax advantage treatment using different structures there. Or even if you look at your individual stocks, Canadian, US dividends, if you're getting interest from bonds, all those kind of things, that you will get a tax receipt for those, and obviously you have to pay the tax on that. But what a mutual fund corporation structure allows is they can write off certain things that could reduce the tax that you have payable on that. So as an example, they can write off some expenses, they can write off capital losses, they can do different things that will give you the benefit of reduced taxes on yours. There's also ETF structures that essentially don't pay any distributions, any dividends to you, so you don't have to pay any tax on that at the moment. And what they're able to do is create a tax-deferred strategy, meaning that you don't have to pay tax immediately, but over time, if you go to sell the ETF units, then that's when you have to pay tax. But that also gives you more control. You're not forced to pay taxes every year. You have the ability to control when you pay tax. And typically, if we can push paying tax into the future, it is better for you, and you can actually improve the return of your investment by not paying tax on an annual basis, but paying tax at some point in the future. Especially for things like US stocks, that some people don't realize that the dividends on US stocks are treated as income. The capital gains there's an agreement between the Canadian and US governments that allow us to have advantage treatment on capital gains, but not on US dividends. So if you have a whole bunch of US stocks, particularly in your corporation, then you need to be really careful and you need to evaluate whether or not these strategies would work for you. And if you look at the benefits of them, you don't have to pay tax on an annual basis. You have to pay capital gains at some point in the future as opposed to interest. And it really gives you the ability to control when you pay tax. If you have a heavy tax year, you can choose not to sell any units. But if you have a light tax year, you could then choose to sell some of those units. Or maybe you have a loss that can counterbalance that. And that's something that you need to pay close attention to, because I know sometimes mutual funds get a bad rap, high fees, et cetera, but they do have advantages on the tax front. But you also have to make sure that you're buying a product, a mutual fund, an ETF, for the investment return as well, not just the taxes. Because I've seen many people get into situations where they just buy something for the tax savings, and the investment itself is horrible and doesn't work out. And you need to make sure that it's for both reasons. But if you can get solid returns plus better taxes, that would definitely help you out. if you're looking to have a discussion on how that might fit in with your individual portfolio, your corporate portfolio, your personal portfolio, please reach out and click on the book a meeting with me. I'm happy to have a chat just to see if there's any opportunity for you to reduce the tax bill in your bill, and in some cases significantly reduce it. So I look forward to hearing from you.